Legendary investors like Warren Buffett, Boaz Weinstein, and Robert Kiyosaki are warning about a cataclysmic market event that will affect everyone. In this video, we will discuss why Warren Buffett, Boaz Weinstein, and Robert Kiyosaki are sounding the alarm for U.S. investors, and what we can do as an investor to safeguard our money and future. The famous founder of the Rich Dad, Poor Dad wealth building business, Robert Kiyosaki, recently offered an extremely unsettling assessment of the global economy, tweeting, quote, "Many of you know I do not invest in equities, bonds, ETFs, or MFs. Please do not listen to what I'm going to say next. I would get out of paper assets. The world economy is not a market. I believe economy is the biggest bubble in world history. God have mercy on us all." Similarly, Warren Buffett is also sounding alarm bells. Buffett Indicator is saying that the U.S. market is overvalued by almost 53%, indirectly saying we are still heading towards a downturn in the stock market and economy. The Buffett Indicator is a valuation model used to assess how expensive or cheap the aggregate stock market is at a given point in time. It was proposed as a metric by investor Warren Buffett in 2001, who called it, quote, "probably the best single measure of where valuations stand at any given moment." Boaz Weinstein, famous for his credit default swap and capital structure arbitrage trading strategies that he employed in the early and mid-2000s at Deutsche Bank, who today has $4.6 billion in assets under management, recently issued a grim warning that the U.S. stock market could be headed for a decades-long bear market, stating, quote, "I'm very pessimistic. There isn't a rainbow at the end of all this. Quantitative tightening is going to be a real headwind for investors." In this video, we're going to discuss, again, why Warren Buffett, Boaz Weinstein, and Robert Kiyosaki are sounding the alarm for U.S. investors, and what we can do as an investor to safeguard our money and future. So, let's start. Things are very rough under the surface. Robert Kiyosaki is not merely predicting a downturn for the broader economy and a period of weak performance for the stock market, he's predicting economic calamity. As he recently stated, quote, "Gold, silver, Bitcoin may protect your wealth, but not your income. As economy crashes, stock markets go bust, pensions crash, and unemployment rises, a side hustle may provide you income. Who knows? Your side hustle may grow into the next Amazon or Bitcoin. Take care. Be aware."
The biggest losers are people who have never lost. You know, they're the people sitting on their 401ks right now, my generation, the boomer generation. They're in serious trouble right now. When they came into the market in the 70s, the stock market was taking off, housing market was taking off. You know, the U.S. came off the gold standard in 71. So the baby boomers are going to get the biggest shellacking of all generations. It's really sad. I can see it coming.
Effectively, what Kiyosaki's saying is that investing in stocks is a losing proposition. Real estate will likely crash, and that cash will also prove to be ineffective against inflation. Instead, he views gold, silver, and individual side businesses and hustles as the best ways to protect against what's coming. There's no doubt that the SPY has had a strong decade with a 9.34% CAGR for investors. But times are changing. Based on the historical data, the Buffett Indicator looks to be a bit on the high side at the moment, with the total market value to GDP ratio at around 158%. Now, while this is down significantly from the bloated levels seen a year ago, it remains elevated relative to historical norms. It's, in fact, 23%, or nearly 1.5 standard deviations above than the long-term trend line as illustrated in the chart below. This indicates that the SPY is likely to underperform its historical average of around 10% annual returns moving forward. Other valuation models also indicate this, including the yield curve model, whose recent inversion signals trouble is ahead for the economy. The price-to-earnings model that shows the U.S. cyclically adjusted price-to-earnings ratio is around 1 standard deviation above its historic average. And the S&P 500 mean reversion model that shows that SPY is currently trading at 27%, or around 0.8 standard deviations above its modern era historical average. The yield curve valuation model implies that the stock market is significantly overvalued, as the recent inversion of the yield curve is sending a strong recession signal to the markets, given that past yield curve inversions have been very reliable indicators of recessions. The SPY's current P/E ratio relative to its historical average since 1950 indicates that the stock market is currently overvalued as well, given that it's currently 45% higher than its modern era average of 19.6. Meanwhile, Boaz Weinstein pointed to the Japanese stock market, which has been struggling for over 30 years since 1989, as an example of what the US markets could have in store in the coming decades. A decades-long bear market is not without precedent. Japan's Nikkei 225 index reached its peak in 1989 and has remained in a bear market ever since. In fact, it's still around 30% down from its 1989 heights. When you look at the trajectory of the SPY over the past decade and compare it to its longer-term trajectory, you can certainly see how an extended period of little to no returns could be warranted, as the trend line shot sharply higher from 2016 until the beginning of 2022. Even this year's sharp pullback has failed to create a state of undervalued stock prices. But things are about to get real worse. The Fed is on pace to cut $95 billion from its balance sheet per month, despite knowing full well that the U.S. economy is headed straight for a recession. As a result, Weinstein thinks that the coming recession could last for an extended period of time and may also be fairly deep. He said, quote, "There's no reason that this difficult economic period will only last 2 to 3 quarters, and no reason to think we'll have a soft landing or a shallow recession." When you compare current valuations to current macroeconomic trends, the likelihood for the SPY to deliver high returns over the next several years is already unlikely. However, when you also factor in the enormous geopolitical risks that are growing more severe and more strained by the week, well, the outlook's even gloomier. If Russia's conflict in Ukraine were to drag on for much of 2023, or worse yet, escalate into a broader Eastern European conflict, or go nuclear, or even spread into the Middle East, by the way, note Iran's and Saudi Arabia's growing involvement in the war, well, then it could further drive up energy costs, bring Europe down even further economically, and push the global economy into an even deeper and longer recession than currently expected. Then, there's the risk of war erupting in the Far East, which could easily turn into World War III if not managed carefully. North Korea has been ratcheting up tensions with South Korea and Japan with its latest round of missile tests, and China's getting ever closer to invading Taiwan, it appears. If any of these geopolitical risks were to become reality, especially the Chinese invasion of Taiwan, we could very possibly see a global recession that could last for a while. None of this geopolitical risk, by the way, seems to be priced into the equity markets at present. What does this mean, though, for SPY investors, especially for those who have taken the simple path to wealth and the 4% rule that involves the regular dollar cost averaging into low-cost index funds like SPY's investment strategy and then living off a 4% annual liquidation of one's SPY shares? Well, it means that this approach is more risky than ever. In addition to the fact that we're likely to see below average real returns from the SPY over the next 5 to 10 years due to high inflation, high interest rates, and a weakening economy against a fair to slightly overvalued price for the fund, there's also the geopolitical risks to account for. This means that the most likely scenario for SPY in the coming 5 to 10 years is one in which it generates a CAGR net of inflation that ranges in the positive and negative low single digits. This means that, at best, 4% investors will be treading water, but they're much more likely to see principal erode at a pretty rapid rate in the coming years, especially if we see a further sell-off in the near future. Now, as a result of this risk, we think it's much more prudent, especially for investors either in or nearing retirement, to adopt an income investing approach to retirement. This way, investors can live off of the passive income thrown off by their investments without having to eat their principal and lock in losses and long-term wealth destruction by selling during a bear market.